Hi, I'm Andrew K. Wallace. Picture a quiet office floor in early 2026. No television screens, no shouting, just a wall of dashboards showing liquidity flows, settlement delays, cross-border exposure, and compliance flags lighting up in muted colors. Somewhere in that room, a decision is made to reroute capital out of one jurisdiction and into another. Not because of war, not because of elections, but because the rules of money itself are changing, and the people with the most to lose noticed first. That's the context we're in right now. Most people encounter this shift in small, forgettable moments. A payment that takes longer than it should, a transaction flagged for review, a spending category that suddenly requires verification. Nothing dramatic. But to anyone who studies systems, these are stress fractures, signals that a structure is reaching its limits. Central bank digital currencies didn't emerge because governments wanted more power in the abstract. They emerged because the existing monetary framework stopped working at scale. Cash is anonymous. Cash is offline. Cash is uncontrollable. And in a world of ballooning sovereign debt, fragmented supply chains, and instant capital flight, uncontrollable variables don't survive. So the incentives aligned. CBDCs promise efficiency, faster settlement, lower transaction costs, reduced fraud, real-time policy transmission. All of that is accurate. But accuracy isn't completeness. Every system optimizes for something. In this case, the optimization target is control over monetary flow. Once you understand that, everything else falls into place. Cash isn't just a payment method, it's a buffer, a gap between the individual and the system. It introduces friction, and friction limits enforcement. Remove cash, and you don't just modernize payments, you compress optionality. That's the first hard truth. With a CBDC, money becomes a live instrument, not a static store of value, but a dynamic policy tool. It can be issued with conditions, it can expire, it can be redirected, it can be taxed at the point of use rather than at the end of the year. Not theoretically, operationally. This is what people mean when they talk about programmable spending. It sounds technical, even boring, but the implications are structural. When money is programmable, compliance is embedded. You don't need new laws. You don't need enforcement campaigns. The system enforces itself. And importantly, this doesn't require authoritarian intent. It requires administrative necessity. Ask yourself a simple question. If you were managing a highly leveraged economy with shrinking productivity growth and rising social obligations, would you prefer blunt tools that take months to influence behavior, or precise tools that act instantly and invisibly? That choice is not ideological. It's managerial. So governments talk about inclusion, about stability, about modernization. And again, they're not lying. They're selecting from a constrained menu of options. Cash-based systems leak too much information. They allow economic activity to exist outside models, outside forecasts, outside enforcement. From a risk perspective, that's unacceptable once the stakes get high enough. Here's where daily life starts to intersect with abstract policy. Imagine paying rent. Today, it's a transaction. Tomorrow, it's a conditional process. Funds are released if criteria are met, location verified, category approved, timing enforced. The experience remains smooth until it doesn't. And when it doesn't, there's no one to argue with. There's a system message. This is behavioral taxation in its most advanced form. Not a new tax rate, a new logic. Spending aligned with policy flows freely. Spending that isn't encounters friction, not punishment, adjustment, short delays, reduced limits, increased scrutiny. Most people won't notice at first. The system will be rolled out gradually. Cash usage will decline naturally. Merchants will stop accepting bills because it's inefficient. Banks will reduce ATM networks. Fees will appear quietly. Not bans, just neglect. There's a threshold in every system. Once cash usage falls below a certain percentage, maintaining it becomes unjustifiable. That's the pivot point. After that, anonymity isn't removed, it's deprecated. And deprecated systems don't come back. This is where a deeply held belief breaks down. The belief that financial privacy is a right embedded in money itself. In reality, privacy only exists when systems allow it. In a fully digital monetary architecture, privacy must be designed, enforced, and protected. And anything that can be designed can be redesigned under pressure. Pressure always arrives. Supporters will point to safeguards, oversight committees, legal constraints, and those will exist, initially. But safeguards that reduce flexibility tend to erode when flexibility becomes the difference between stability and crisis. That's not cynicism, that's pattern recognition. The people building these systems think in scenarios: inflation spikes, bank runs, capital flight, climate shocks, geopolitical fragmentation. CBDCs offer something legacy money doesn't: real-time visibility, real-time control, real-time response. From their vantage point, this isn't about watching individuals. It's about stabilizing flows. But stabilization has a cost, and the cost is optionality. Watch what sophisticated capital is doing right now. Not headlines, balance sheets. It's diversifying jurisdictional exposure, reducing reliance on single monetary rails, holding assets that don't depend on one ledger. This isn't rebellion, it's risk mitigation. Corporations do this instinctively. Individuals rarely do. Most people will experience the transition as convenience, faster payments, instant refunds, seamless integration with identity systems, until a moment arrives when something familiar stops working the way it used to. A transfer pending review longer than expected, a spending category restricted temporarily, an account limited due to a compliance trigger you don't fully understand. Temporary is an elastic word. By the time these frictions become noticeable, the infrastructure will be deeply embedded. Employers will pay in digital currency, governments will distribute benefits digitally, taxes will be calculated and deducted automatically. Exiting the system won't be illegal, it will just be impractical. That's the structural compression of choice. This is the second hard truth. Power doesn't need to be exercised to shape behavior. It only needs to be possible. When people know money can be paused, redirected, or conditioned, behavior adjusts upstream, quietly, rationally. No force required. This is why I describe this period as the final days of financial freedom. Not because freedom disappears overnight, but because it becomes conditional, managed, something you have to plan around rather than assume. The old model treated money as neutral, separate from governance. That model is obsolete. Money is now infrastructure, and infrastructure is always governed. Once you see that, the noise falls away. The debates about intention miss the point. Systems don't care about intention. They respond to incentives, and the incentives now favor visibility, control, and speed over anonymity and friction. That's the autopsy of power. Not villains, not conspiracies, just structures adapting to survive. There will be no announcement declaring the end of cash, no single law that changes everything, just updates, standards, interoperability frameworks, each one reasonable on its own, together, irreversible. And when people finally realize the room feels smaller, it won't be because something was taken. It will be because something quietly stopped being offered. Those who understand this aren't panicking. They're not protesting. They're positioning. They're studying where optionality still exists and how quickly it's narrowing. Because in the systems that are being built, survival doesn't belong to the loudest or the angriest. It belongs to those who anticipated the shift before it became visible. Power moves quietly, money even more so. And by the time most people feel the walls closing in, the doors won't be locked. They'll just be very, very far away.